Welcome back. You're watching The Money Show with me, Kavita Thapliyal. Investing in funds is one thing, but reviewing your investment and the performance of the funds you have invested in is crucial for getting the most out of your investment. So, on The Money Show today, we will discuss how you can analyze the performance of your fund. We have Sandeep Pandey, Director, Basav Capital Advisory Private Limited. Sandeep, good evening and welcome to the show. Very crucial assessment that one needs to do, and in fact, make it a habit to do it for their investment portfolio. You know what happens is a lot of times people think that investing in a mutual fund is just like buying stocks. You know, you have an entry time, you have an exit time. But when it comes to a mutual fund, you can decide an entry time maybe if you want to, but that's also not recommended even then. When it comes to seeing the performance of a fund, a lot of factors go into it, Sandeep. So let's break this down. When you talk about performance, this should be based on what criteria? You know, your fund's comparison with the peers, with the benchmark, or any changes happening in the fund management team. How do you look at your fund's performance? What are the criteria laid down here?
Kavita, first of all, thank you so much for inviting me for such a prestigious, a show as such. A lot of retail investors are fan of yours and always looking forward for your advice. And thank you so much once again. So coming back to, in terms of how to analyze your fund performance, more important aspect before it goes is the client profiling. Client profiling plays a very, very important role before you select a fund in terms of what is his goal, what is his objective in investing a fund, whether it's a short term, whether it's a long term. More importantly, what is his family composition, whether he's a first time investor or he's just because ads are coming, mutual fund sahi hai, he wants to just invest and take the ride. What is the risk behind it? So an advisor or the wealth management team, whether it's IFL, whether it's MK or the best of boutique firms which are there in India, should analyze the risk profiler and then go to the fund selection. And more importantly, there are different kinds of parameters which you already covered very smartly in terms of what are the parameters one should look forward in evaluating the fund. So first, importantly, what we look forward is what is the risk-adjusted returns. So risk-adjusted returns shows the what is the kind of risk a fund manager takes in generating that kind of return, whether it's 15%, 20%, or 25%. Okay, what is the risk behind that portfolio? For a debt scheme, the risks are different. For an equity scheme, the risks are different. And what is the consistency? So what we always tell our retail investors that these two parameters play a very vital role, and return should be the benchmark. You're not investing in the equity market just to invest. The returns play a very, very important role, and that's the end figure. Just like cricket, I'm a sports guy, so I always look forward for giving examples to my clients on basis of sports. So in cricket, if you hit a century, that's the end story, which gets reflected on the scorecard. You take a wicket, that's the end story. So same way in a mutual fund, what is the kind of return a fund is generating, whether it's 6 months, whether it's 1 year, whether it's 2 years, or since benchmark, that plays an important role. So this is one of the key parameters, is the return is the ultimate criteria for anyone to have as a judgment of that particular fund.
Sandeep, now just for example, let's take a scenario where the market is going down, okay? At that time, if someone wants to maybe exit a fund, okay, how should you be looking at the performance? How should you take that exit call when the market is already down?
So, Kavita, again, very important point is that people get panicked. You have seen during, the wave, the kind of, corona wave, people panicked and lost crores of rupees in their portfolio, their hard-earned money itself. So here the advisor comes into play a very important part. The more the conviction, and I always tell my clients not to just invest in fund, but also give them the knowledge. I have a huge client base who are doctors and very well CEOs and top notch managing directors of a company whose portfolio I manage. So I always try to give them the knowledge. What is the main objective of your and whether this particular objective has been met by investing in this fund, and what is your tenure. Hence, the profiling, which I earlier mentioned to you, plays a very, very important part. If the profiling and fund selection and the goal setting plays an important role, then naturally the ups and downs will not affect. And you have to remind the customer or the investor again and again that you have not invested for 3 months, 6 months, or 1 year. Your intention is to create a corpus either for your retirement or depending on purchasing a house. So why are you getting affected with a short term kind of scenario where there is a war scenario or there is a change in regulators or taxation? These are the bips which advisor plays important role in convincing about the goal objective setting, and about also giving that kind of strength that yes, the long term the markets are good. And India has always been a investment and hold strategy. Indian regulators also do not permit in doing short selling. And I don't think so. Our markets are well equipped unless it's in a very HNI or a very, very senior shark who's there in the market who can do short selling in the market. So most of the people who are there, retail investors, they buy and they hold. So when the markets are going down, I think so the advisor plays important part, and you need to be convinced about the objective and the economy about a country itself.
All right. And the same rule applies, Sandeep, when the market is on a high and when you are seeing the profit ballooning from a fund, and if you want to take an exit call, will the same criteria work over here?
Yes, Kavita, it works. In fact, there is no harm in booking the profits unless and until you're going to park that money again into your fixed deposit or in your savings account, and your short term goals are getting fulfilled. I think so. Yes, booking profits from time to time also plays an important part, but there's a big difference in terms of booking profit and doing churning. So a lot of investors fall in a trap of advisor where 3 months back a mid cap story was running, then a large cap story was running, and the advisor comes back to a customer again and again that move from A fund to B fund. So churning is where a dent happens to the retail investor, specifically the entry and the exit load. So the client needs to be aware, okay, what is the objective? Unless there is a fundamental change in that particular fund, whether there is some kind of integrity issue, if there is some kind of structural issue of that fund house, or there is some negative news like what happened in Axis AMC in terms of front running, people should avoid doing trades again and again, and you should give sufficient time to your fund manager to give you a returns. So your selection criteria of the fund is where you spend the maximum time, which is 70-80%, and then taking calls on a regular basis by sitting with your advisor plays an important part. So usually you should sit around 3 months, every quarter you should sit with your advisor and just reviewing the portfolio instead of taking decision again and again.
All right, one last question to you, and then we'll wrap up this discussion. There is a lot that goes on having the right kind of expectation, having the real expectations from your returns. So how would you like to explain how investors can have a real return expectation, and how should they be altering it or modifying it as per the market movements as well? How can one be very realistic with their returns? Yeah.
So, Kavita, very important questions that many a times, people get very anxious when you're getting a low return and get very excited when they're getting a good return. So, you have to always have a benchmark against your investment. If you're investing in a debt fund, your benchmark usually is a 10-year yield, GSEC bonds, which is ranging around 7 to 7.5% itself. So that is your benchmark. And in equity, if you're taking that kind of risk as such, so you should, if the Sensex is performing say 12 to 15%, your mutual fund should perform 3 to 5% more. So that is where you have to do an outperformance. And if you're taking an exposure of a PMS, the return, because you're paying a higher fees and more concentrated portfolio on a PMS, so naturally, a return should be much, much higher than the benchmark, maybe outperformance or alpha generation of more 5 to 6% more than your benchmark itself. So you need to have your expectations right. And it should also, you should not get carried away that 1 year, if a fund is giving you a 50 or 60% return, or a PMS is giving you a high return, you need to also see what is the kind of risk an individual has taken. whether this kind of consistency for a long term is going to sustain in the market or not. And that's where your previous question, the booking of profits plays a very important part. So this is what I would love to tell my retail investors who are watching the show, is that review your portfolios on a regular basis and keep something which is stable. Even Warren Buffett says that generating a 12 to 15% return from a long-term point of view is excellent, and he's one of the richest investor in the world itself.
All right, Sandeep, with that, thank you so much for being a part of this show and explaining all the nitty-gritties involved with fund performance to our viewers today. Thank you.
Thank you, Kavita. Thank you so much. Take care.
All right, we move on. Let's take a quick break, but then post that we'll be joined by Feroz Aziz and a lot more on financial planning and ITR filing, and also your portfolio related queries, which will be a part of this show after this break.